I am going to post the solutions to the end of chapter questions 1 to 8 and also to the activity book because there's quite a lot of information in that. But I will run through this question 3 now just to explain it to you. So you're to calculate the gross profit percentage and the net profit percentage for the 2 years. So you have your sales figure, you have gross profit and your net profit. And the answer to that then obviously is where you have your gross profit percentage, 90,000 divided by the sales, 180,000 multiplied by 100. Do the same for the second year, and then the net profit, the same again, 65 divided by 180,000. Now we went through that question in class. So the solutions are there, and this PDF or file will be put up online for you to use and correct your answers. So we went through that in class, but remember 1 year to the next is an increase is always good, and decrease is a negative trend. And looking at gross profit, what gets taken out of that is your costs. So you'll be focusing in on costs when you're commenting. Net profit, it's all about expenses, so focus in and comment about that. So like they have here, the gross profit percentage has increased by, and give the figures, 5% from year 1 to year 2. And the management should be happy with this positive trend. The net profit percentage is falling, however, by 6.1%, and management need to take action to reverse this negative trend. Overall profitability in the company is good. However, they have to look at what's happening here with expenses and how to cut those expenses. So question 4 then is a general question about explaining what is meant by the following terms. So all the definitions are there in the chapter. You can have a look at that yourself. And just to comment on here, the rate of stock turnover. So 8 times in 1 year, whereas 5 in the next. So comment on that trend. Obviously, there's a decrease. And why is that? So sales aren't as good. But the solutions are all there for you to have a look at. So question 6 is looking at year 1 to year 2. This time you have to look at the liquidity, so your working capital ratio or current ratio as it's also called, and your asset test or quick ratio. So remember, the formula is current assets divided by current liabilities for the current ratio, and then you take away closing stock for the other ratio for the asset test ratio. So current assets divided by current liabilities. So you have more assets than liabilities in this year. However, they're slightly above it. But currently, remember, the norm is 2:1, so this should be okay here. 95 compared to 50 here in year 2. Okay, so looking at the solution there, you can see that 80,000 divided by 42 is €1.90 for every €1 owed. But the norm is 2:1, so it's slightly below the norm or the ideal. Same in the second year, so that's an issue and has to be commented on. Hasn't reduced, but still an issue. Asset test, once the closing stock is taken out, and you divide the 50,000, so 80,000 minus 30 is 50, divided by the 42 current liabilities, means it's 1.2:1, so that's above the norm or the ideal, so that's not so bad. However, in the second year it's reduced, so negative trend, and there's issues there still with the current assets. So what's happening here? Our debtors not paying back. If you're not, why don't you have enough money in the bank or the business and cash at hand? So mention all those figures. Comment on the ideals and what they can do to address that, what that means and what they can do to address it. So I put up these solutions, and you can check off your answers with that.